Basically, auditing is this. And when you pass the CPA exam, we get the CPA license. It licenses you to do financial audits. That's what it licenses you to do. Like you get a driver's license, you can drive a car. You get a CPA license, you can perform financial audits of companies. No one else can. If they don't have a license, they can't do an audit of it. The financial audit. Now, what you do as an auditor is the company makes their own financial statements. The auditors do not make them. The auditors write a report on the financial statements, and that report goes along with the financial statements. So the auditors, all they do is write a report. Now they'll come in and they'll see, okay, you say your sales are 5 million. Well, let's check and see what they are. And, you know, they go through all the numbers, but then they'll write this report, and this report will basically say whether the financial statements can be relied upon or not. Okay, so that's all auditing is. Auditing is going in, looking at the financial statements, and then you write a report. You don't touch the financial statements. You say, well, why don't you just make the financial? If you're an auditor, why don't you just make the financial statements? Then you would be you wouldn't be objective. You'd be biased. You're looking at your own work. So you do not touch the financial statements, but you write the audit report. As a matter of fact, let's take a look at the audit report. Actually, at the end of this thing, let's go down here. I'm getting a weird ghost thing in the middle. If you go down to page 11, maybe. This page 10. If you go down to page 10, you go down to page 10, you will see the audit report, what it looks like. This is the international one, but the US one looks pretty much the same. And what you're going to do is you're going to make an opinion on the financial statements. And this first thing here, you just come right out and say it. You know, we audited the financial statements. So this is. And then down here, in our opinion, the financial statements present fairly in all material respects. The financial position, these are just the financial statements. Okay, so, you know, we present but we're only looking for material respects, things that are just in our material. So this report will go along with the financial statements. So the income statement, statement of retained earnings, balance sheet, statement of equity or retained earnings, whichever one they have. They tell whose standards they use. Key audit matters, which are different, blah, blah, blah. But let's go here to the auditor's responsibilities on page 11. And this is that we obtain reasonable assurance about whether the financial statements are materially misstated due to error or fraud. And this is very important. We do not give absolute assurance. We give reasonable assurance. And we're not looking for all misstatements, only material ones. And we don't care whether it's fraud or error, whichever one it is. If it's material, that's what you write up about. Okay, so this is we'll go through this a little bit more later on, but basically this report will go along with the financial statements. So they'll issue their financial statements, and that report goes along with it. Now, here's the weird thing about the way I look. Here's a weird thing about auditing that's very different than any other profession, whether it be lawyers or doctors or whatever. We have to be independent from our clients because we're supposed to be objective, and we're looking at these financial statements, and we're going to put this report on that the public is going to be relying on. So we have to be independent from our clients. That's very different than doctors or lawyers. You know, a doctor, if their kid falls down, and I can't put a Band-Aid on, or it's not like that. So with the auditors, if your child says, I need to get an audit done, you can't do it. So, there's this kind of strange thing in that you have to be independent from your client or your customer when you're doing audits. And it's a very serious thing, because the only thing that the audit report gives is credibility. And if that credibility is gone, it's a useless report. Okay, so that's kind of what auditing is. Up here. And by the way, if you want to get participation points, and you can put stuff in the chat too. That's, if you don't want to speak up, that's fine too. Okay, so here's kind of the two groups that we're comparing. The International Ethics Standards Board for Accountants. So this is, we're going to look at the independence issues first. And in the US, we have two different groups. We have the Institute of Certified Public Accountants, AICPA, but we also have the PCAOB. This is a government agency. Okay, the naming of things is a little bit different, and I don't know why they don't just use publicly and privately traded companies, but publicly traded companies, the international standards, they call them public interest entities, or PIs. In the United States, we call them issuers. They issue financial statements. Privately held companies you can't buy stock in. Non-PIs and non-issuers. And the reason we separate these out, especially in the United States, but also other countries too, is that generally the government has control over publicly traded companies. They generally don't over privately held. So, for instance, the government has control over IBM. They tell IBM what their financial statements, what methods they have to use, and all this kind of stuff. Okay, IBM has to follow what basically this, the Public Company Accounting Oversight says. Privately held companies, Joe's Hot Dog Stand, they could do whatever they want. The U.S. government, the United States government, anyways, has no control over them. It's privately held. There's nothing to do with the government. So, okay, so this is, kind of a little bit. I mean, it's not a big deal, but just getting the different kinds of naming of stuff involved. Now, just like the accounting standards, the auditing standards referred to as a principle-based code, whereas the US standards are more rule-based. And while they're very similar, there are a few differences, which we'll talk about a little bit. Okay, in the US, some of these differences are addressed by the PCAOB standards. All right, so what is that? So the international standards, for example, they prohibit the installation of accounting systems. So you can't install an accounting system for your client and then go audit it. The idea is that you must be kept separate, from them, and you don't want to audit your own accounting system. So they prohibit the installation of accounting systems. Our group, the AICPA, they allow it. However, our other group, the big group for the big companies, they don't allow it. So while the two main standards are different, overall, between the AICPA and the PCAOB, they're the same. Okay. Now, these independence rules. I should probably go into a little bit about the CPA firms, how they're organized according to the AICPA. So and we can do it on the sheet here. How they're organized. This is the kind of the ladder that you'll have for a CPA firm. The partner is the one that brings in the business. They're the highest you can get. Manager will run multiple audits at the same time. Seniors will usually run 2 or 3 audits a year. An associate is where you come into the firm. And each one you're hired by partners. A partner will hire, associate. Maybe they have 30 associates. The partner will hire them. The partner will hire the seniors, the manager, and all that kind of stuff. So these are all organized underneath the partner. The partner is the one that actually gets the business for the audit. Okay, so this is kind of the structure. And this is the structure the AICPA kind of goes by. And the AICPA states, look, if your firm doesn't use this structure, you have to find the nearest thing in those 4 categories to put everybody. So you might say, well, we don't have manager, we have whatever else you have. Okay, well, whoever you have, you got to find who goes into this category, for some, maybe it's a, square peg in a round hole or whatever it is, but you got to put them into these 4 categories, whatever your structure is, because the rules are often based on those categories. We'll find that here. And the big one for this is being independence. And the audit section, the audit part of the CPA exam, about 20% of it has to do with independence. It's huge because all we do is give credibility to the financial statements. Have you guys talked about taking the CPA exam in your other classes?
We've talked about it.
Talked about it, but not really. Not even going in depth. Well, maybe we'll do that at some point. Maybe do that next week. I'll pull up some stuff. But anyway, at about 20% of there's 4 different sections. One of those sections is auditing, and the auditing section, about 20% of it has to do with ethics, and most of that is independence. The only thing we give is credibility. That's it. There's nothing else. If we didn't have credibility, it wouldn't make any. It doesn't matter how smart you are, you don't have credibility. It's nothing. So independence is key. And when you're an auditor, you go into a place and you do the audit. There's a lot of people in the company that know way more about the company than you do, right? If someone is in the accounting department every single day, they're going to know a lot more than the auditor knows, but they're not independent. So independence is a really big issue. And they basically break it up into who should be independent, that if they weren't independent, it might compromise the audit. It might make the audit worth less. And the first people they come up with are the people who are on the audit team. So the people who are on the audit team, the audit engagement team here, people who do the audit, those people all must be independent. And by the way, these are the AICPA. This is the US standards. All of the partners in that office must be independent. Okay, so this is in the audit office. There also is, a lot of times in the CPA firm, there'll be a consulting office. And these are called non-attest services. They're not, there'll be things like taxes, consulting. They write that in here. They'll do things like taxes. Consulting. It's possible they put in system stuff. But they don't do the audit. So up here they're doing the audit. Oops. And down here they're doing all the other stuff. Now in the non-attest office, people who do the consulting, say, or taxes, only the partner and manager must be independent. These other two do not. These are, well, here, I can come on here, I guess. Yeah, okay, so all members of the audit engagement, all partners in the engagement office. And down here, these are often called 10-hour people because they have to do at least 10 hours of work to be before they have to be independent. If they just call up about some tax issue and it takes an hour to do it, they don't have to be independent for that. But if they bill out for more than 10 hours in a year, then they also have to be independent. Questions on any of that? Questions on why we have to be independent or anything? So we have to be removed from the company, and that means we can't have ties to the company, financial ties or employment ties to the company. And we'll talk about some of the limitations on those. And what we're going to do is we're going to learn the U.S. standards, and we're going to learn the international standards, because there's actually a pretty big difference between them, and it's a really big topic right now, and I'll explain why later. But there's a pretty big difference between them, and how that's playing out is a little bit frightening, but we'll take it later. Okay, there's some other people that we're not going to talk about. These people down here. There's actually 3 more categories that we're not going to worry about too much. This is kind of a catch-all down here. Anyone in a position to influence the audit, the CPA firm itself is a covered member, and any entity that's controlled by covered members is a covered member. But these first 3 here, these are the ones that we really focus on. Okay. So some of the rules. Direct financial interest. So what is a direct financial interest? It's directly investing in the company's securities, usually stocks or bonds. Um, Too many T's. All directions are prohibited. So all direct all direct financial interests are prohibited, even if they're immaterial. So if, for example, if we're, let's say we're auditing IBM, I use IBM down here. Okay, yeah. If I'm using IBM, you cannot own any IBM stock. One share, too much. Okay, indirect financial interest. Is when the investment isn't direct. I know that's kind of a well, duh, we could have figured that out. But I'll just kind of explain it here. I'll give you some examples about. Okay, you make an investment in a mutual fund. Now, the mutual fund buys the stocks. You don't buy the stock, the mutual fund does. So it's indirect. You bought an investment in the mutual fund then buys the stocks. So this is an indirect investment. So mutual funds are one of those things that are indirect. You invest in a bank. Bank loans money to the audit client. So you invest in a bank. Now the bank, they're trying to make money too, obviously, and they loan money to your audit client. So indirectly, your client pays the bank interest, bank pays you dividends or whatever. So those two are two that are very common to have for indirect financial interests. Any questions? That's not me. Any questions on that? Okay. So indirect. Now, so what are the rules for indirect financial interest? Indirect financial interests are only allowed. Indirect financial interests are only allowed. Excuse me. If they are immaterial to the covered member. So they're allowed if they are immaterial. So you can have a mutual fund, as long as the amount that's in the mutual fund that's invested in your client is immaterial. You can have an investment in the bank as long as the amount that the bank loans out is, the proportion is immaterial to the overall bank activities. Okay, so let's take a look at the AICPA cases. Gina is a member of the audit engagement for IBM. She owns 5 shares of IBM stock. The ownership is immaterial to Gina. Okay, is Gina a covered member? You gotta go up here. She's a member of the audit engagement team. So would you be a covered member? Okay. Yes, she's a covered member. The interest is direct. She directly owns the stock. It's immaterial. Is Gina in violation of the AICPA independence rules?
Yes.
Yeah. Immaterial doesn't make any difference. You can't have any of it. Okay. Greg is a member of the audit engagement for IBM. So he is also a covered member. Anyone who's on the audit is a covered member. He has an investment in a S&P 500 mutual fund. IBM is in the Standard & Poor's 500. Now, the Standard & Poor's 500 mutual fund has 500 companies in it. All right. So he invests in a mutual fund. The mutual fund invests in the stock. So is this direct or indirect?
Is it direct?
It's actually indirect. He bought the mutual fund then bought the stock. So there's there's something in between him and buying the stock. So this would be indirect. Now, is it material? There's 500 companies in the Standard & Poor's 500 fund. So in other words, even though IBM is one of them, it's one of 500. There's 499 other companies in it. So is the IBM portion of this going to be material? It's 1/500th of the mutual fund.
Immaterial?
Yep. Good. Yeah, it's immaterial. I mean, there's 499 companies. Whatever IBM does, no matter good or bad, is probably not going to make much difference in the fund. Now, is Greg in violation of the independence rules? It's indirect, but it's immaterial. It's indirect.
No.
No, it's not. Yeah, it's not a problem. Okay. Helen got cut off here. Hold on. Okay, Helen is not a member of the audit engagement team. Okay, so she's not on the audit engagement. However, she is a senior auditor in the office. Okay, so let's go up here to our little, I don't know what you want to call this. Not really a. So she's not on the engagement team, but she's a senior. So let's say that she is, let's say this is Helen. So this is Helen. Too many L's in there. No. So here she is. So Helen is a senior. She's not on the engagement team. She's not a partner. So is she a covered member?
No.
Nope. Not a covered member. She owns 500 shares of IBM stock. Is this investment material to Helen? 500 shares of IBM stock is probably $60,000 or $70,000. It's a direct interest. And I don't know Helen's financial, but my guess is it's material. May not be. Maybe she's very wealthy. So is she in violation?
No.
No. She's not a covered member. She doesn't have to follow the same rules as other people do. So Helen does not have to follow the covered member rules. Okay. The second thing we're going to look at is people say, okay, well, okay, so I'm a covered member. I can't own IBM stock. I know. I'll give it to my spouse, my wife or husband or, boyfriend or, girlfriend or whatever. And that way, everything will be okay. Well, immediate family members include spouses, spousal equivalents, there you go. Dependent children. So these are all immediate family members. Immediate family members are basically the people you see when you go home. Who's there when you go home? That's your immediate family member. And notice for this one, it's only dependent children. If you have independent children, people that have moved out or whatever, not an immediate family member. Okay. Immediate family members are considered to be the covered member. So I go home and I give the IBM stock to my child and say, here you go, give me this, whatever. That is the same as me owning stock. Immediate family members are considered to be the covered member. In other words, it would be the same as the covered member. And all the same rules apply. Okay. Sharon is a member of the audit engagement for IBM. Okay. So she is a covered member. She does not own any shares of IBM stock, but her husband owns 10,000 shares IBM stock. Okay. Direct or indirect? Now remember, the husband is the same as the covered member. So it's the same as if the covered member owns 10,000 shares of IBM stock.
Direct interest.
Yep. Direct interest. And you can say whether it's material or not, but truthfully, in this case, it doesn't really matter. If you're a covered member, you cannot have a direct interest. I imagine 10,000 shares of IBM stock, which is probably like $1.5 million or something. I imagine it's material, but it really doesn't even matter because whether it's material or immaterial, violation. Yep. Okay. Steve is a member of the audit engagement. He does not own any shares of stock, but his dependent daughter, so dependent daughter, so someone living at the house still, owns an immaterial amount of IBM stock. Okay, he's a member of the audit engagement team, so he's a covered member. Dependent child, same as the covered member. Is this direct or indirect?
Would it be direct?
Yep. And now they tell us it's immaterial. They really don't even have to tell us that. Is Steve in violation?
Yeah.
Yep. Any family member is exactly the same as the member. Okay, and down here, this one's a little bit of a judgment call. But so Jolene is a member of the audit engagement for IBM. She does not own any shares of IBM stock, but her husband has a large investment in a technology fund. Okay, so it's a fund, but it's for technology. And it just so happens that 40% of the fund, the technology fund's holdings are in IBM stock. Okay. Covered member, family member. Is the interest direct or indirect? Technology.
Is it indirect?
Yep. Yeah, it's a technology fund, so the fund is there. Now this is where it becomes a little bit tricky. They just tell us that it's a large investment. Oops. Yeah. And 40% of that large investment is in IBM. So is this likely to be material or immaterial? On this one, depending on which way you go with it, you could your thought process could probably be defended. But what do you think? So big investment, and then in this fund, and 40% of it is in IBM stock. So a large percentage of it's in IBM. It's not one in 500. It's 40%. What do you think, material or immaterial?
Material.
Probably. There's such a large percentage of it is in that, a large concentration. And if it was material, is joint in violation? Yeah, because you can only have an indirect interest if it is immaterial. For an indirect interest to be okay, it has to be immaterial. This is material. Now, if you looked at this, and some reasonable people might say, well, it's a large investment, but this is only 40% of it. Maybe that percentage of it isn't as large. It's not as large as the thing overall, but it's hard to say with the vague terminology. But yeah, so you do run into kind of these judgment calls of what is material, and what material can be for different people. I worked with a woman who came from a very wealthy family, and she would never pick up her paycheck. Back then we had to go pick up our paycheck, but she would never pick up. And they would say, okay, we got 6-year paychecks for the last 6 months. You need to come pick these up. But that was just you may not. It's not the same for everybody, to put it that way. So it really depends on the member themselves. Okay, so let's go to the international standard. Okay. The international standard rules, I'll just tell you right up front, they're a little more lenient than the US ones. What we call a covered member, and this isn't a big deal, this is just terminology. We call them covered members. They call a member of the audit team. Okay. Coming down here, financial interest, prohibited. Only material financial interests are prohibited for the members of the team, whether they are direct or indirect, doesn't matter. So you can have a direct interest. You have if you're auditing IBM, you can have IBM stock as long as they are not material. The holding is not material to you. And by the way, the US standard, the reason why they're so kind of strict with that is that what they don't want to do is have the kind of sensationalism of the auditors own stock in this company and they did a bad audit and whatever. You don't want to have that kind of reduction of credibility. One of the things about independence is it needs to be in fact and in appearance. Now, if I own 5 shares of IBM stock, I probably wouldn't care one way or another whether they were what the audit was. But the appearance might be, look at these people are investing in this, and they're supposed to be the watchdog, and yet they're investing in these companies. So international standards are, though, only material financial interests are prohibited. It doesn't matter whether they're direct or indirect. So material investment, whether it's direct or indirect, is prohibited, but immaterial ones are not. Permitted if certain conditions exist or specified safeguards are applied. We'll talk about those later. Family members' financial interest in the client, either material or immaterial. So it's possible that your spouse or your child could have a material direct financial interest in the client, and you still do the audit. Way different than this one is way different than the US one. The US one's a big no-no. This one is a that if there if there are safeguards that are put in, we'll talk about those in a minute. It's possible you can do it. So circumstances requiring an analysis of threats and application of safeguards when necessary. A business relationship between an immediate family member and the audit team and that's it, of the audit team and the audit client or its management. Oh my God. Okay, so when they say special circumstance requiring an analysis, this is actually what they mean by this requiring analysis. You have to document it. So for instance, if your spouse is a supervisor at IBM, you know, what is that? You know, what does that mean? Or actually, I jumped ahead. This would be if you have your spouse or something as a business relationship. In other words, maybe they do business with IBM. I jumped ahead. This is one down here. Yeah. Okay, so and again, especially when they say requiring analysis, that term might not seem that important, but what that means is you have to document it. Whether you allow it or not, you have to document it. Okay, down here, they jumped ahead. Prohibited. A family member, director, officer, or client or employee in position to gain significant influence in the preparation of financial statements and records. Okay, so it's prohibited to have a family member who is in what they call in the US standards, a key position, somebody who has control. Now, the one I just gave you, if your spouse is a supervisor on, say, the loading dock for IBM, they probably don't have a whole lot to do with the financial statements. So that probably doesn't really matter. Now, if they are the chief financial officer, that's a problem. But, you know, so it really depends on where they're at. So you can have a spouse, a family member, a dependent child, whatever it is. You can have them in your working in the company as long as they do not have any control over the financial statements. Now, so employment, that's an employment rule. The AICPA rules are the same, but they also say close relatives. And close relatives would be somebody like siblings, parents, non-dependent children. Those are all prohibited by the AICPA. They are not prohibited under the international standards. And this can create a problem because you might have, maybe your parent is somebody up in the company, you know, working as a controller or accounting manager or something, and you won't be able to do the audit because, and through no fault of your own. Right? So the international standards are that your immediate family members cannot be in there. AICPA standards are also close relatives are not allowed. Your parents, non-dependent children, your siblings, your brothers, sisters, and all that. Specific circumstances requiring an analysis of threats and application of safeguards if necessary. So this again, when they say analysis, this isn't just a throwaway term. You actually have to document your analysis of whether these are threats to independence, and if they are, what you did to mitigate those, or that you decided that they were just too big and you couldn't overcome them with, you know, safeguards. So immediate family member of our team employee exerting significance of the client's financial position or cash flows. This is kind of a wacky one. Financial position this is all balance sheet kind of stuff. So financial position, balance sheet, financial performance is income, and cash flows. This is more along the lines of an operating director. So if they're not necessarily directly in a financial one, but an operating director, say, that you would then have to have an analysis to see if you can do the audit. A close family member. So now we're getting away from the immediate family member, but a close family member who is a director, blah, 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 blah. So when I said up here that it's prohibited for close relatives, down here, if they are a close relative, a close family member, then you have to do an analysis. But it is possible that you can still do the audit. So you may have your mother as the controller and still do the audit. A member of the audit team has a friend who is not an immediate family member, but who is a director, blah, 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 blah. So friends are also in there. And by the way, up here, these close relatives, one of the things that's included in these are friends, but I didn't put them in. This is close relatives is more likely what they use down here. So, but friends are also, they don't, the AICPA does not separate them out. AICPA says sibling, parents, non-dependent children, and friends are all the same. Okay, so what we're going to do, and we'll take a break. I went a little long here. We'll do these. These are the cases using the international rules and see how they kind of differ from those that we did for the AICPA rules. They're the exact same cases. So Gina is a member of the audit engagement for IBM. She owns 5 shares of IBM stock. This ownership is immaterial to Gina. Is Gina in violation of the rules? So it's immaterial.
No.
Nope. No, notice that for the AICPA it was a hard yes. You can't have any shares with that. This is not independent. No, there's not even a question about it. It's immaterial. Not in violation. Greg is a member of the audit engagement. He has a mutual fund investment. Okay, so this is indirect. No, we already talked about it. It's indirect and it's immaterial. So is Greg in violation?
No.
No, it really doesn't matter whether it's direct or indirect for the international standards. It's just, is it material or not? And Helen, Helen's not on the engagement. Another thing about the international standards is it only applies to those who are on the engagement team. So, no, not a member of the engagement team. Helen can do whatever she wants. Sharon is a member of the audit engagement team for IBM. She does not own any stocks, but her husband owns 10,000 shares of IBM stock. Is Sharon in violation of the independence rules? Anyone hazard a guess?
Yes.
Well, actually, maybe. It actually is maybe. family members, you have to take those as a separate case, each one of them, to see if they are, family members, financial, either, it's permitted, conditions exist or specified safeguards apply. So this is a maybe. Steve's a member of the audit engagement for IBM. His daughter owns an immaterial amount of IBM stock. Immaterial. Steve in violation. International standards.
No.
No. It's only material. So again, this one was it was a hard yes up above. Joan is a member of the audit engagement. She doesn't own any stock, but her husband has a large investment. Let's say that it's material, just for fun.
Would that be yes?
Actually, it's gonna be another maybe. Is a family member. The it's important to know that family members are the family members are that it's possible for them to have material investments, direct material investments, and still take the audit if there are safeguards in place. We'll talk about the safeguards later. Okay, so yeah, so very strange, that there's a lot of maybes, and they would have to do some analysis and see if they think that it affects independence. Now, here's the reason why I bring this up, and I know I'm going late here, but the reason I bring it up is that a couple things are happening. There's been a lot of problems with independence recently, and a lot of audits all over the world. And a lot of these are audits done under the international standards. So there's kind of a push to tighten up the international standards. At the same time, in the United States, the CPA firms in the United States are saying, look, there's a lot of business that we can't take because we're hemmed in by the US standards, whereas everybody else is using these international standards. And so in the United States, there's actually kind of a push to ease up on these independent rules. So you got to have two things going on here. The international standards, there's a big push to tighten them up because there's been problems with independence. And the US standards are just going the opposite way, where there's a big push to ease these standards because they say, look, you're just hampering US companies that we can't do some work that others, other auditing firms all around the world can do. So anyway, there's that kind of a fight thing going on right now. Okay, let's go ahead and take a break. Let's be back at what time is it? Oh boy, 7:04. Let's say 7:14. Oops. Okay, go ahead and get started. A few more things. Management decisions. Okay, all of the international and US, all those standards all prohibit us making management decisions. Reason the financial statements are the result of management decisions, and you'll be auditing your own decisions. So you cannot make management decisions if you're an auditor. The international standards, they'll make an exception that if they are routine, administrative, or insignificant, that those are not considered to be management. So it is possible that if you're doing something for the client that's routine, administrative, or insignificant, that is not considered management, and that is not allowed in the US. Okay, expert witness services. Expert witnesses are sort of like when a company goes to trial for a lawsuit or something like that. You bring in an expert witness, and there are firms that do business that way. They'll be an expert in whatever, and they'll do business. Now, if the U.S. company is basically banned, there's like a small little loophole that if you're representing an entire organization and one of them is one of your clients, for instance, if you're doing something for the auto industry, as an expert witness for the auto industry that includes 8 companies, one of the companies you audit, then it's allowed. But for the most part, it's banned. You can't be you cannot be an expert witness. And as he said, you can be actually allowed if safeguards effectively extinguish it. And you're going to see this time and time again. Safeguards. This is one that's kind of strange, really strange, actually. Contingent fees. Contingent fees are based on an outcome. So, in other words, you get paid a certain amount. It's contingent on some factor. For example, a CPA firm giving a $10,000 bonus for a clean audit opinion. Okay, so that $10,000 bonus is contingent on a clean audit opinion. AICPA banned all contingent fees for audits, and actually even the test functions, even things that aren't audits, but you're testifying to. You cannot take a contingent fee. Obviously, you look up here, this does not seem like you're independent. Amazingly, this one really is kind of a head scratcher is why they would allow this, but they allow it if they have safeguards. Represent clients in tax court. Basically, this is not allowed for U.S. company. Only routine tax matters are allowed, and routine tax matters don't end up in tax court. For instance, paying the sales tax or something like that. That's not controversial. But if you end up in tax court, then you're looking at a law case. And auditors are prohibited from being advocates for clients. We're supposed to be the guardians. We're not supposed to be their advocates. We're supposed to be the people that come in and look over the books and no oversight, basically. And so we cannot be advocating for them. International standards. If they are not material and safeguards are applied as needed. Okay, loans from clients. Example, an audit member is working on an audit for Bank One. The audit team member has a loan from Bank One. There are some ways that these are allowed, but the US rules are much more stringent than the international standards. If it's an arm's length loan and it's, you know, making the payments or it's paid up and all the information, all the backing, the collateral and all that is along normal guidelines, it's fine. So if you have a car loan, you're auditing Bank One, you have a car loan through Bank One, that's fine. Okay. Inadvertent independence violations. This one is actually kind of interesting. So here's an example. Wow. Example I just goofed up. After a clean audit report, so you got, you know, everything's okay for IBM client, a member of the IBM team realizes that their spouse has a material direct investment in IBM, the client. The spouse had no idea that the team member was auditing IBM. I worded that wrong badly, but the spouse had no idea that their spouse was a member of the was auditing IBM. Okay, inadvertents are allowed if certain conditions apply. So the international standards say, okay, well, if this happened, you can apply for an exemption. Basically, if there's certain things that, you know, came into play, like nobody realized it, you know, no one knew about it, no one acted on it. The AICPA and PCAOB are they don't allow for exemptions. I'm not going to do that. So what happens? Attempts should be made to redo the audit work using a member using independent auditors. The audit cannot be repeated, and the CPA firm must reissue the report as a disclaimer, which we'll talk about in a moment. We're almost done here. We get done a little early. Entertainment from client. Entertainment from clients is allowed if it is trivial and inconsequential. That's the international standard. The US standard is actually much more lenient. It's reasonable in the circumstances. And I'll tell you what this really relates to. why the US standards are much more relaxed. It's golf. A lot of times these companies will have golf outings and things like that. A lot of times they do it at country clubs and things like that. And those rounds of golf are thousands of dollars. They're not inconsequential or you know, trivial. And under the international standards, they're not allowed. The US standard allow them because it's such a part of the culture. United States, we have tons of golf courses, and a lot of times people in companies play golf. That reason one of the circumstances being like, okay, if you're going to go play golf, that, you know, even though it's $4,000 or whatever the green fees are, that it's allowed because of the circumstance. So this is one of those. This is an international rule that is more stringent than the US rules. Okay, now, so far we've seen a lot of these application of safeguards. And here's some examples of them. Professional regulatory monitoring and disciplinary, external review. So have somebody else come in and look at it. That dog you hear going nuts is Polly. He sounds like a grizzly bear and she weighs 13 pounds. All right, using different partners engagement team to separate out reporting lines. Okay, so it is possible that they have other partners come in, people from who are separate from the teams come in. And having an accountant who is not a member of the audit engagement team review the work. And by the way, a professional accountant is kind of what they call auditors. CPA is certified public accountant, even though we do auditing. It's CPA is certified public accountant. So and remember that when you're going through like the CPA exam, when they talk about the accountant, they're usually talking about the auditor. Kind of weird thing. Okay. A few other things that are different. Some of these make sense, some of them don't. Contacting the client's legal counsel. Contacting their lawyers. International standards is optional. US standard is required. So talking to the client's lawyer. Hey. It's optional for international firms. It's required for US. Anyone know why? There's actually a really good reason why in the US you have to talk to their lawyer, whereas in other countries you don't. What's different about the US than other countries? Legally. We have way disproportionate judgments compared to other countries. Other countries, like for instance, someone's injured or killed or something like that, they have kind of charts and rules that they go through. United States, they get a flashy lawyer and you might get $50 million. Other countries, they don't look at it that way because $50 million means you're taking $50 million from people who have nothing to do with this, whatever it was. Kind of a more social thing, but they have absolutely astronomical judgments in the US compared to other countries. You don't see these millions of dollars, tens of millions, kind of lawsuits. So United States, we say, hey, you have to talk to the lawyer because there might be these millions and millions of dollars of lawsuits hanging out there. Other countries, it's not that way. If someone's injured, if something happens, they kind of know exactly what they're going to pay out. It's going to be a certain amount, and that's what it is. And you don't necessarily have these kind of possible huge payouts that you have in the United States. It's a legal system. So this one actually makes sense. Other countries, they don't have the crazy lawsuits. It's up to you whether they're going to contact the lawyers or not. United States, you have to, because it could be, they could bankrupt, a profitable company could be bankrupted by that. Okay. Accounts receivable confirmations. International standards are optional. US standards, they are required. I think this might change for international standards because there have been some huge. By the way, what do we mean by confirmation of accounts receivable? Well, here, let me go back in there. Let's say you want to cook the books. Okay, so you say, okay, I'm going to put on a bunch of sales on the books. Right, so I'm going to make my sales go way up. So I'll just fictitiously fraudulently add. Oops. $20 million. Oops. Cannot type. No, Mark. Hey, how about that? Okay, so here's the journal entry. Well, here's half the journal entry. So I put these sales on the books. I say, okay, I need to hit my sales numbers. Okay, I put $20 in the sales. Now we have a double entry system. No. So we're gonna have to have a debit. So what goes on the other side? Well, the common thing that goes on the other side is accounts receivable. Now notice that these are not really, these are fraud too. I'll clean up my spacing here in a second. If we make this journal entry and they're fraudulent, this is a fraudulent journal entry. Notice these accounts receivable, those are never going to get collected. They're fictitious. They're not real. So confirming the accounts receivable, and that's you actually send out confirmation letters saying, do you owe this money? Those are important because you can find stuff like this. There have been some absolutely huge accounts receivable frauds recently from a lot of international companies. And part of the reason is they don't require, their judgment was we don't have to confirm these. So they had all these unconfirmed accounts receivables that were on the books that were fictitious. And it's happened several times. So I think the international standards might change this. I'm not sure, but it certainly seems like that it's one of those things that could happen because it's been very large recently. Okay, audit opinions. We'll do these. This will be the last. Okay. Unqualified opinion sounds bad, but it's actually good. The financial statements are free from material misstatements. Another way to say it is the financial statements are fairly represented. Go a little way. Financial statements can be relied upon. Okay, so we say they're free of material misstatements. We never claim that they are accurate. But, and by the way, this is an unqualified opinion. I know this sounds kind of funny. The US terminology is unmodified opinion. It used to be unqualified opinion. And I think when we get to this qualified opinion, I think it'll make more sense. Okay, so this is what most companies get. And by the way, most companies get a clean audit opinion. And we'll see why in a minute, that you always give them a chance to correct their financial statement. So if you do find a problem, okay, this is misstated by some amount, you always give it to the client and hope that they're going to make the changes. So you say, oh, look, these sales, these aren't really sales, these are it's overstated, we want you to do the, to correct it. And hopefully they'll do it, and they usually do. Okay, so if they don't get an unqualified opinion, they get a qualified opinion. Qualified opinion. When a material misstatement or uncertainty exists another kind of terminology you think they a lot of times will say is the material misstatement. Oops. Is not pervasive. I spelled that right. In other words, it's confined to one. I didn't spell that right. Usually confined to one account. These are called except fors, and the except for is a qualifier. The way these reports are written, they say everything is okay, except for. Except for is a qualifier. That's what's qualifying this, is saying, okay, everything's okay, except for here's the qualification on everything is okay. So going back to the first one, that's why they call the first one the unqualified. There is no except for. It's like everything's okay, nothing else. Whereas the other one is everything's okay, except for here's the bad thing. Okay, and in these ones, the dollar amounts will be given. Oops. So if you're trying to get them to change the books, they will know that even if they don't change them, that you're going to put it in the audit report. It doesn't do a company any good to have this qualified opinion, because anyone reading it is going to say, okay, the sales are really overstated by 20 million or whatever. And now it also looks bad because the company's trying to hide it. So that's why a lot of times when you say to the company, look, you're going to get a qualified opinion. If you don't change it, they will change it. Adverse opinion. This is the worst opinion. The financial statements are not GAAP. Oops, that's not a. Material misstatements are pervasive. And again, just like this other one, the dollar amounts will be included. So for qualified and adverse opinions, the dollar amounts that they're off by are going to be put in the audit report if you don't change it. Now, do these opinions happen? Yeah, sometimes they happen. But it usually happens out of more of a, I don't know what you want to call it, a passion or something rather than logical thinking. You know, why do they happen? Because people start pounding on tables saying, well, I'm never going to change this. And well, you have to change it, you know, and then they get a qualified or adverse opinion. It's not a logical thing. The logical thing is it's going to be in the report anyways. People are going to know that this is overstated by some amount. Change the financial statements, you know, that and get a clean opinion. That's what you do. You know, but again, you know, this is usually a lot of times these are confrontational or something, you know, whatever you want to call it. A disclaimer of an opinion. The auditor is unable to get enough evidence to support an audit opinion. This is kind of like what it says, no opinion. And in some ways, it's one of the, other than the adverse opinion, is probably the worst because it doesn't say anything. At least with the qualified opinion, you can say, okay, yeah, we have a problem with the inventory, but the rest of it's okay. You know, this one is nothing. You know, here's nothing, here's our bill. So, you know, this disclaimer opinion, the auditor is unable to get enough evidence to support an opinion. And they're not be able to get evidence could come from a few different ways. One of them could come from that the client won't allow them to get the information. For instance, one part of the audit in the United States, you're required to talk to the lawyer. We talked about that. Suppose the client says, you're not talking to my lawyer. So we have to talk to your lawyer. It's, you know, we're required to talk to your lawyer. Well, forget it. I'm not talking to my lawyer. Okay, so the client is not letting you talk to the lawyer. So that will generally get a disclaimer because a couple things going on there. First of all, you have to be able to get, you know, you're required to get it. It isn't like it's optional. So you're required to get it. Second of all, whenever somebody doesn't allow you information, you have to wonder why. Why don't you want me to talk to your lawyer? That indicates there might be a problem, right? Kind of like if there's a murder and I say, yeah, you can come look in my house, you know, wherever you want to go, but just don't look in this closet, you know. Well, the first place you want to look is in the closet because that's what I don't want you looking. So, you know, that's so when a client doesn't allow you to get the information, they get a disclaimer a lot of times because you simply don't know what's lurking out there. It could also be not their fault, you know, that gee, we had, all our computers were stolen last week, you know, and you don't have any accounting records or anything like that. You know, okay, well, you got backups, right? Yeah. Where are they? Well, they're in the safe. Okay, where's the safe? Well, they took the safe too. You know, it's all gone. You know, so you don't have anything to work with. It is possible that happens too. You know, thefts, fires, things like that. So they might get a disclaimer for that also. I think we're done, aren't we? Yeah, we talked about this already. Yeah, that's just the audit report. Okay. Okay, well, there's that for that one. So, let me get that. So you guys, yeah, I'll give you guys extra credit points on these. You guys were good this week. All right, any questions on that? I was gonna give you guys a problem. I don't think I'm not going to. Maybe next week I'll give you guys a couple problems. But I think people still need to turn the test in, so. Any questions?
Nope.
All right, see you guys. Have a good weekend.